I'm here in Hong Kong talking with Professor Joseph Fung. We can just talk a little bit about the Chinese economy generally. With the slowdown in the EU economies, with what's been happening in the US, do you feel that there's a concern that the Chinese economy is slowing and it's less of an attractive place to do business?
Well, the concern is justified. And as the Chinese economy grew by around 8% in the last few years, and in the first half of this year, the growth rate dropped to about 7.6%. And the projection is that the growth will further slow down to 7.5%. However, according to a recent forecast by the World Bank, the world economy is set to grow only at around 2%. And if you look across the Atlantic, the Eurozone countries are having historical high unemployment level. So if you look at the economic situation, China is still a very attractive place to invest your money in. Well, however, you look at Chinese economy, although it has been slowing down in terms of growth rate, from around 8% down to about 7.5%, 7.6%. However, compared to the World Bank forecast of the global economic growth, globally, the economic growth will be around 2% overall. And if you look at compare that with the European countries, the European countries are recording a historical high unemployment rate. And so relatively, China is still a very attractive place to put your money with.
Joseph, I'd like to talk a little bit about trade and investment opportunities in particular in the Chinese market. Starting with trade, what are your views about consumption and the role of the Chinese consumer at the moment?
Well, the role of Chinese consumer spending is getting more important as the Chinese government has moved from export-oriented growth to more balanced growth. That is, well, you are right, the European economy has been pretty sluggish, and so the Chinese government has been trying to supplement the slowdown in export by an increase in local consumption, so in consumer products and also in services. Say the growth, the domestic growth rate in the first half of this year was 7.6%. And however, for wholesale and retail trades, it accounts for 10.2% in growth rate. And financial intermediation accounts for 10.8% growth rate. And so we can see from the numbers that, well, the Chinese economy has geared more towards domestic consumption and into the tertiary industry. And on the other hand, if you look at the Chinese growth policy, they're actually moving towards the western side of China. And so if you may see that some of the production capacity are moving to the other Southeast Asian countries, but China is expanding its capacity to inland, to the western part of China.
Joseph, I'd just like to pick up on a couple of points you made there. Regarding the Chinese consumer, do you think they're becoming more sophisticated? What sort of opportunities do you see in the Chinese market for those outside of Australia, say outside of China, say in Australia, who are wanting to export into that market?
Oh, that is a very good question. Yes, as we see that the Chinese have experienced a pretty rapid growth in their income these days, and so you see that there's a general increase in demand for higher quality consumption goods. At the same time, there's a huge demand for luxury items, and in particular, gold. And China actually is one of the biggest importer of gold. And I guess Australia perhaps is a very important supplier of gold to China. Well, again, it will depends on industry. And again, China is premature in terms of attracting foreign investment. So China started the open door policy back in 1979. So that was 30 years ago, more than 30 years ago. So the process is premature. And so if you look at the infrastructure and the legal structure are pretty much intact. And at the same time, China is not offering as much incentive as before to attract foreign investment. However, China has a huge market. It's a huge potential market for Australian products, just like from the other countries too. So in terms of production of what we call the labor-intensive light manufacturing, well, China may be losing its edge compared to the other neighboring Southeast Asian countries, just like Malaysia, Indonesia, Thailand, or Vietnam. However, China is still, in terms of the labor costs and the other production costs, and China is still a pretty attractive place to produce. And most importantly, China has a huge market for consumption goods and services. And that will open up a huge opportunity for Australian companies as well as the other companies from all over the world.
Do you think there's an opportunity to use Hong Kong as an entree into the Chinese market, or is it a matter of moving directly into China?
Oh, that is a very important question for all the companies. They want to have a foothold in China. And actually, compared to the early years after the open door policy back in 1989, and it is actually easier to set up shops in China. And because the process is more mature, the legal framework and also the infrastructure are more mature. And so foreign company can actually to start a joint venture or wholly foreign-owned enterprise in China. And however, China is still pretty low in terms of ranking according to the ease of doing business. Say, for example, the legal issue that the investor have to deal with, regulatory issues, business cultural issues, corporate governance, especially when the business involves a local partner. And so there's an alternative. Is perhaps we can make use of Hong Kong as a stepping stone into China. And Hong Kong and China, actually China allowed Hong Kong to export to China tax-free starting in 2006 through what we call the CIPA program. And so if the target market is in China, an Australian company can actually start a company in Hong Kong or to form a joint venture with Hong Kong partners in Hong Kong. If the product produced, for example, by the Australian company or by an Australian-Hong Kong joint venture in Hong Kong, so they could be they satisfy the rule of origin, and they could be exported to China tax-free. And so that will give the Australian company a niche and compared to directly shipping a product to China.